This is just another way that people can at least explore, how could I get more access, allocate more to Bitcoin in a safe, secure, proven way using tools that are safe and proven, etc. And that's kind of at the heart of this, right? Is for the people that make that decision, that say, okay, I want to do this, or at least I want to explore it. As these risk and underwriting and profitability models are evolving, they're starting to look more at the future appreciation value of Bitcoin. They're looking at the growth and the CAGR as really their economic upside, as opposed to strictly at the risk. There's fantastic tools out there. There's fantastic literature, best practices, things of that nature. And that's kind of the heart of, own Bitcoin, rent dollars, is just trying to break that down to give people more practical guide on how to do it and why they might want to consider it. You can preserve and grow that wealth. You can allocate, or you can stack Bitcoin much more quickly, and you can still get access to the fiat that you need to live your life.
Hi, Shane. How are you doing? Everything fine in your end?
I'm great, man. Great to see you again. Appreciate you having me on.
Absolutely. Last time was really cool and people loved it. And so I was like, let's do it again. And you wrote a book and you're doing the strategies of and I love the title of it, like own Bitcoin and rent dollars. Maybe let's start directly within that. What do you mean by like own Bitcoin and rent dollars?
Yeah, well, at least where I've grown up and, most of my experience working, earning money, saving, things of that nature, it's really just been based around dollars, right? Your whole life has been denominated in dollars. We're taught to save in dollars. We get paid in dollars. We pay our bills in dollars, right? And then if we're lucky, we might have some savings left over to invest or to buy Bitcoin or to go on vacations or do whatever we want to do. And this just kind of flips that upside down, right? Instead of saving in dollars or earning dollars to pay our bills in dollars, this says, no, convert all of your economic energy, right? Your income. You go to work and you give your employer your time, your energy, your blood, your sweat, your tears, and in exchange, they pay you, right? That's your economic energy. And so what this suggests is that by converting that economic energy into Bitcoin instead of dollars, and then borrowing those dollars that you need against the Bitcoin as collateral to live your life, to pay your bills and do everything else, right? This theory and this methodology basically suggests that you can preserve and grow that wealth. You can allocate, or you can stack Bitcoin much more quickly, and you can still get access to the fiat that you need to live your life.
What is kind of because there's like basically two strategies at some point when you have Bitcoin and you get in this, like first when people get started with Bitcoin, they usually just like use it as some diversifier, some investment, and then they start saving more in Bitcoin. And then, they get to this point where most of their wealth is in Bitcoin. And at that point, they have to ask themselves a question of, do I want to spend my Bitcoin if I need them, or just like borrow against them? Like there's like a fundamental decision that they at some point have to take. How did you come to the decision of saying like, I want to borrow against it and not spend some of them?
Yeah, I mean, I think with Bitcoin's ascension as a capital asset, as a store of value, as a, collateral asset, it's just become one of the more strategic ways that people are taking advantage of the Bitcoin itself, right? So I work for a Bitcoin-backed lending company, right? One that's been around for almost a decade. And so I've gotten a lot of great firsthand experience and exposure to how does this lending thing work? What is custody and how do you borrow against Bitcoin? And I've really gotten the perspective of Bitcoin as collateral, and that's allowed me to take that into my personal life and say, oh, could I do that for myself? Could I deploy my own personal Bitcoin treasury where I deploy my own wealth, my own income into this pristine collateral asset and then borrow dollars against it to live my life? And that's kind of at the heart of this, right? Is yes, Bitcoin is a fantastic savings account, right? It's a fantastic store of value. But once you start thinking about Bitcoin as pristine collateral, right? It's an asset that you can invest in, right? That you can get allocated to that will appreciate itself, right? As the asset, but you can also borrow dollars against it as collateral, right? So that really gives you, it kind of doubles the overall value that you can get from the asset itself, as opposed to just having it as a savings account and still living your life in dollars. And so once I understood that, once I started thinking about Bitcoin more as a form of collateral and not just a savings account, that's when I, was able to go down the other rabbit holes, pick up the other books, ask the other questions, and start teaching myself about how to do this, right? What are the tools? What are the best practices? What's LTV? What's a margin call, right? All these things. And then I was able to apply that to my own life, figure out a strategy that worked for me as far as risk management, as far as how do I protect my Bitcoin? How do I use only what is needed to get loans? And then how do I kind of manage the risk and how do I manage that process across the different tools that I'm using? But ultimately, for anybody that's at that point and that wants to take that step, there's fantastic tools out there. There's fantastic literature, best practices, things of that nature. And that's kind of the heart of, own Bitcoin, rent dollars, is just trying to break that down to give people more of a practical guide on how to do it and why they might want to consider it.
Do you think this is a strategy for like everyone, or is there some situations where you say it's probably not a good idea for someone to do that?
It really depends. And what I would say is that for anybody who's trying to figure out how to accumulate maximum Bitcoin, like if that's the goal, then yeah, they should at least understand this method, understand this process so they can make that decision, right? This is ultimately just equipping people with more education, more information that they can use to make that decision for themselves. But for me personally, I wanted to stack more Bitcoin, but I wasn't going to get another job, and my current job wasn't going to pay me 3, 4, 5, 10 times as much money so that I could buy 10 times more Bitcoin. And so this was inevitably the best path and the best strategy I could come up with that allowed me to maximize my allocation without, again, having to get a second job or ask for, pay increases all the time so that I could further my accumulation.
It's interesting because like if you read, for example, the fiat standard of Cypherdine, you kind of come to the conclusion you might want to use the fiat to buy more Bitcoin. Of like, okay, Bitcoin is a great solution. And then you wrote the Bitcoin standard, you read the Bitcoin standard of Cypherdine, and then you go to the fiat standard of Cypherdine and you're like, oh, I need to misuse the fiat system to the fullest potential to get as many Bitcoin as possible. Now, it's very hard for me because I purposely decided to just like go the other way around and just like spend my Bitcoin. And this was just more of an emotional and not a financial decision. I just like did not want to have any debts. I just want to be like debt free. And it is very hard because I know how bad the fiat system is. And so I know how good of a decision it is to borrow against your Bitcoin or even get a loan. And I still have a small loan outstanding. I did a small experiment with myself in 2022 where I got a loan for, I think it was 15,000 euros. And I think it was 8 years or something, like the numbers could be slightly off. I think 8 years, and it was like 3% or 4%. Like it was super low. And I was like, wow. Like, and at that point, I just wanted to try it out and see like, what does this actually mean? So I didn't do any borrowing against the Bitcoin, nothing else. It's just like a consumer loan after applying for like 20 loans, and one I got that was really good and favorable. And looking back, this was one of the best decisions I ever took. It was at the at the bottom bear market of 2022, and 15,000 euros. I mean, that's just like extremely good from a perspective of how much more money I made with that trade, renting the dollars and like buying the Bitcoin with it over the last 3 years. Like it was like tremendously good. And still, even though my only experience with loans are extremely good and financially good, I I just don't want it. Like it's a weird thing where like emotionally, I no longer want it. And so in hindsight, I just like wish, even though it was a financially good decision to say like, I wish I'd have never done it. Now, of course, it's a good thing because like I made the experience, I know about it, and like it's nice. And it also has nothing to do with borrowing against your Bitcoin because it was just like a loan. And so, that, so I struggle in my head because on the one side, I really don't like it. But on the other side, I know financially it is in most cases. I mean, I don't want to say with every cases, but in most cases, a pretty good financial decision. So I have those two hearts in me.
Yeah. Yeah, and I think you are thinking about it through the right perspective, right? You're taking a low risk, how do I mitigate risk and protect my Bitcoin first and foremost. And that's how everybody should approach it. And that is one thing you will have to accept and that anybody has to accept when they do post their Bitcoin as collateral. And we talk about that in the book, right? Is which path would you take? Because there's really a couple different paths you can take. You can trust a regulated money services business like the company I work for, which is Salt Lending, or you can work with other lenders, right? There's Ledin, there's Strike, there's Arch, there's a number of others. And then you've also got decentralized finance, right, which also has some pros and cons. So there are a couple different paths, and each one of those paths has completely different risk vectors, things that you need to learn, best practices, different tools. And that's really at the heart of this whole thing is like, look, don't just dive into this. If you want to explore this as a strategy to accumulate more Bitcoin, there are some best practices. There are some things you can do to protect yourself, but at least have the fundamental understandings of how it works so that you can make an informed decision for yourself. And if you get to that point like you have where it's like, yeah, I understand it, but I'm still not comfortable with it, then you shouldn't do it, right? This is really for people that um, have decided that they want to put their income more into Bitcoin. They want to take loans against it to pay their living expenses and buy their food and pay their rent using borrowed dollars because they want to arbitrage that spread, right? Kind of like what the Bitcoin treasury companies are doing, which is I'm going to raise capital at, Saylor raises capital pretty cheaply and takes that capital and invests it into Bitcoin, which he predicts will return, say, 30% over the next 20 years. And his cost of capital will be more like, 7 to 10 or whatever it is, right? So if he's earning 30 on the asset that he's buying and it's only costing him, say, 7 to 10, well, then there's the spread, right? There's the difference. And so when you apply that to yourself as an individual with a job, and you say, well, the savings in my bank account are earning nothing, and I'm getting no raises at my employer, yet the cost of living goes up 7 to 10% every single year due to inflation. How can I protect myself? And the answer is you can't, right? You have to get another job, or you have to get a raise, or you have to, come up with some other magic formula that for a lot of people just doesn't exist. And, that's kind of at the heart of this is just another way that people can at least explore how could I get more access, more allocate more to Bitcoin in a safe, secure, proven way using tools that are safe and proven, etc. And that's kind of at the heart of this, right? Is for the people that make that decision that say, okay, I want to do this, or at least I want to explore it. Own Bitcoin, Rent Dollars is just a great guide, a great sort of TLDR 15-minute read that covers the basics to help people just learn the fundamentals and know where to go to get more information if they truly want to dig in.
And I want to show a chart because it's really interesting. Also, the risk management of that from the book. This is it was explained previously, but like what is kind of this chart showing of the risk level that someone can take within borrowing against your Bitcoin?
Yeah, absolutely. Yeah, and if you scroll up, if you go to the top of that, let's see. Yeah, the relationship between these two. So if you go to, yep. So this really breaks down the relationship between your income and your expenses, right? So let's say you get $5,000 deposited into your bank account every month for your job, right? That's after taxes. Now let's say that you have to spend 2,500 of that every month on your expenses, right? Your food, your rent, your bills, everything. Well, that means that at the end of every month, you've basically got $2,500 in free flowing cash to invest, to buy Bitcoin, to do whatever it is that you do, right? And so the relationship there between your expenses and your income is relatively modest, right? It's 50%, right? You need 50% of what you make in order to live. And so if you were to implement this strategy, well, in any given month, you would never actually be borrowing more than 50% of what you deposited in Bitcoin, right? Because this strategy says buy Bitcoin with all 5,000 of those dollars and then borrow 2,500 that you need to pay your bills, right? That way you've still got the $2,500 that you need to live your life, but instead of only having $2,500 left to buy Bitcoin, well, you bought $5,000 worth of Bitcoin and still have the $2,500 that you need to pay your bills and live your life. But if you then go to the other example, right, the top example there, right, where your expenses are a significant portion of your income, well, then this strategy is going to be a little bit different for you, and it's going to carry some additional risks where you would probably want to start out with not a significant, but you'd probably want to start out with an ample amount of Bitcoin as collateral, right? So in this example, I think it says what is that? You're borrowing, yeah, you're at 80%, right? So your expenses are 80% of your income, right? And so that's going to put you at a risky level from a loan to value standpoint, which is why in that particular scenario, the individual would probably want to start with some kind of a buffer, say 3, 4, 5, 6, maybe even 12 months worth of their expenses in the form of Bitcoin as collateral. Does that make sense?
Yeah, it is, and so the whole idea is that you buy Bitcoin with all the money that you get in, and then you get basically the amount back each month of what you need for your monthly expenses. So you buy $5,000 of Bitcoin, and because your expenses are like half of that, you are borrowing against that for 50% loan to value, if I understood it correctly.
Exactly. And that's how that would work in that particular example. Yes. The other nuance there though is that depending on which type of lender the individual uses, right, there might be some more rigidity, if you will, in how that works. Because like the company I work for as an example, you can refinance your loan anytime and you don't pay any additional origination fees. It's really easy to get additional cash, right? Whereas with DeFi, right, if you're using, say, Aave or Compound, or you're using like Coinbase's Morpho product or something along those lines, it's a little bit more easy, right? You can just kind of, you have liquidity available on demand, so to speak. Whereas with a centralized finance lender or CeFi lender, like the one that I work for as an example, you just go through the refinance process, fill out sign some additional forms, and then you can get your additional dollars deposited into your account.
Interesting. But
Yeah.
isn't that like the thing is, if you do that every single month, are you not stacking like a lot of debt? Like, isn't then there the problem maybe if there's like a longer bear market? So like if there's something coming your way, I mean, of course, like it has to go down like 50%, but what happens if like Bitcoin goes down like 90% or 80%, even though it is unlikely at this point?
Yeah, and I put a section in here that covers liquidation. I think that's up, let's see. That's on page. Yeah, so starting on page 11, you'll see some of the terminology there about loan to value and margin calls and liquidations. So I think what some people get wrong about liquidations is, let's just take your example, right? Let's say you had $10,000 in Bitcoin that you used as collateral. You took out a $5,000 loan. Now let's say that Bitcoin's price fell by, let's call it 40%. You're now at $6,000 in collateral value. Okay, yeah, you've got the example there, right? So in this example that you're looking at, ultimately all that's happening is the lender is doing a forced liquidation, which does carry a fee, right? But now if you didn't have a loan and your Bitcoin collateral fell by the same percent that you just referenced, well, what's the difference, right? Whether your Bitcoin's being used as collateral or whether it's sitting in your wallet, right? What's the difference? Both of them, in both situations, the value of the Bitcoin has fallen by, let's call it 50%. The only difference is when you're using your Bitcoin as collateral, well, the lender might have to sell some of it to bring your LTV down or sell all of it, right? But either way, the only difference is that if you have a loan, you're going to pay a fee of typically between 2 and 5%. And if you didn't have a loan, well, you wouldn't have to pay that liquidation fee, but your Bitcoin still would have lost the same amount of value due to the volatility. So I think where people confuse liquidation with getting wiped out and losing everything is in these massively levered situations where you've got people taking out 50, 100x leverage. Well, in those situations, yes, if you get liquidated, then the fee that you're going to pay is basically going to consume all of the original capital, all the original assets that you started with. And so that's where I think people conflate, multiple 10, 20, 50x leverage with a simple loan against your Bitcoin at 50% LTV. Those liquidation scenarios and the resulting impacts from those are completely different.
So basically making sure that even if Bitcoin drops 80, 90%, that you're still okay, like making the calculations of like what happens actually if Bitcoin drops drastically, and then still having, enough Bitcoin to post as collateral, enough buffer, like enough a security zone that you're like, okay, even if that happens, I'm still okay. I mean, that's also what Saylor often mentioned, that make sure you're still fine, even if Bitcoin drops like 90%. I think I heard him saying that multiple times, which is, I think in general, like very good advice, especially if you use any form of borrowing against your Bitcoin. I mean, if you have a loan that is not against your Bitcoin, then like you don't care how much Bitcoin falls. You just have to make sure you can service the loan and don't run out of cash. If you don't do anything with debt, then like it doesn't matter at all, because like then it's just like Bitcoin that falls and you only lose if you sell them, which you might also be forced to if you lose a job in a bear market or anything like that. Which is interesting, yeah, because like then if you always have the safety margins, like if always have the safety zones of even if Bitcoin drops 80, 90%, which I again don't believe it happens, but it might, and so you should better prepared for it than not being prepared for it, and it doesn't happen, and it does happen.
That's right. Well, and I think too, another thing that people don't consider, because again, I think there's a lot of people conflate getting wiped out because they've got 10, 20, 50x leverage with a simple 50% LTV loan against your Bitcoin. Like again, the outcomes from getting liquidated in those scenarios couldn't be more different, right? And so I think what people often overlook as well is, let's go to your 80% drawdown example, right? If I've got my Bitcoin posted as collateral and Bitcoin falls 80%, my guess is that I got liquidated when it had only fallen 40 or 50%. So did that protect me from further downside, right? Because if I didn't have my Bitcoin posted as collateral, it would be sitting in my self-custody and it would have experienced the full 80% drawdown. Whereas because I used it as collateral, the lender had to sell some of it or all of it, right, to make sure they were protecting themselves, but that also protected me as well. right? So it does cut both ways. And I think, again, that's the whole point of this, is just helping people understand what is liquidation. How do the liquidation thresholds and mechanisms work? What's a margin call? How do I manage my LTV? What is LTV, right? And so that's what I really want people to start asking themselves and understanding and really digging in to make sure that they have a good grasp on the fundamentals. Because once I understood these things, right, I was in the same place, like, oh, you can't, if you get liquidated, oh, you're done. And then I realized, no, you're actually not. If you're not taking on risky amounts of leverage and you're just doing basic, borrowing against some of your Bitcoin as collateral at a safe LTV, getting liquidated is really not the worst thing in the world. It does cost a fee, and you do want to avoid it, yes, but it's really not the worst thing in the world. And it really just acts as another way, another mechanism in this whole risk management process and series of best practices that I'm hoping people will ask more questions about and double click on and really, want to learn more about.
The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They are also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean. No account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together. I want to tell you about something very special to me. It's called Microseed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today. And you can make with that unlimited amount of backups. Go now to microseed.io. Again, that's microseed.io to get your last backup tool you ever need.
One thing that I think a lot of people also I'm still very careful of is because we had in the past Celsius and like so many other smaller examples of like
BlockFi, FTX.
BlockFi. Yeah,
Yeah.
BlockFi was a big one also because a lot of people also made like advertisements for them. Like,
Yep.
is that still a concern for you where you think like maybe there are still platforms out there if we get, I mean, now we don't have like a screaming bull run as we had it in 2021 or even in 2017. So I don't think there's a huge risk, but is there still something where you say like there is a platform risk to that whole thing also?
Yeah, I mean, yes, that's the easiest answer. Yes. right? I think though the reason why those companies were able to do the things that they did was just lack of regulatory oversight, really lack of rules and structure and regulatory frameworks that we could use to govern these types of entities, which we know, has changed quite a bit since then. The other thing is rehypothecation, right? And we hear that word a lot because that's what got those companies into trouble, right? They were saying one thing publicly, oh, your Bitcoin is safe. Oh, yeah, we store it in cold storage with multi-sig wallets, yada, yada, yada. But what were they doing out the back? They were trading it, they were relending it, they were applying tons of additional leverage on top of it. And so once one of those dominoes fell, the whole cascading effect wiped them all out, right? And so that's why a lot of lenders now, including, Salt, which is where I work, make sure that it's clear in the documentation and in the other information around custody, security, et cetera, that people understand there's no rehypothecation, right? The Bitcoin is secured in, custody environments that are powered by names like Fireblocks, as an example, or Anchorage Digital, or BitGo, or Fidelity, or whoever it is, right? Whereas again, in the past with the crypto cowboys, as Saylor likes to refer to them, they just weren't doing any of those things, right? They were being reckless, they were being careless, they were taking additional risk with the collateral, with the assets, and that's ultimately what led to them blowing up. But back to your question, I mean, is there still a risk that that could happen? Yeah, I mean, I think there is counterparty risk, right? When you post your Bitcoin as collateral with anybody, even if it's just with River or Coinbase or whoever, wherever you might have your Bitcoin, even in cold storage, right? There's still risk. You are a risk, right? So there's always risks. I think it's just important that people understand what those are. They do their research. They feel comfortable and confident with these things before making any decisions. And that's again the spirit of this guide, is to help people understand those things better so that they can make those more informed decisions based on what their goals are.
Do you think there is like a future where there are big banks and they only require a signature as proof that you have the Bitcoin and not real custody, of saying like maybe you have a service provider, you have a bank, and you have yourself, and each of the three like have one key. So like, let's say like there's maybe a Bitcoin exchange that provides such a service. We have the Bitcoin exchange host has one key, then the bank that provides the liquidity has one key, and then you yourself have one key. I thought about that and was like, it's actually interesting, because if we want to avoid the bank doing weird stuff with the Bitcoin, the coolest thing to do would be have a key. And so the exchange and the liquidity provider can still collude to each other. Like they can still like work together and like take your Bitcoin, but you would know about it.
Yeah, right.
Which is kind of an interesting thing where it brings even like more transparency in there. I don't know if there's even something like that on the market, or if that's even like possible. I don't know like what like liquidity providers and like all of that like they want, but is there something that you see that this could be somewhere future?
Yeah, we talk about this a lot. Because multi-sig for self-custody is fantastic, right? The challenge with multi-sig when you get into a lending scenario is you now have, say, a lender, you have a borrower, you have a capital provider, you might even have a custodian, right? So you've got multiple entities that are now involved in this transaction, which makes multi-sig a little bit difficult, especially if the goal is to remain or to provide resilience and security over the Bitcoin. Because to your point, if the benefit for me using a 2 of 3 multi-sig with, say, Unchained or Theia as an example, is that I have 2 of the 3 keys or 3 of the 5 or whatever, right? I control the transactions, not somebody else. But as soon as you bring a third party interest who's now lending money to me, and somebody has to secure the Bitcoin collateral in escrow or at a custody environment or whatever that is, all of a sudden I no longer have control. So what is the value of the multi-sig in that scenario other than you can see it, right? To your point. And so I do think that the multi-sig will continue to be in high demand for lending scenarios, right? Unchained Capital is a great example, right? They have their own multi-sig vaults that they've built. They also do lending. But I think if you look at, some of the LTVs and some of the rates where multi-sig is being used for security and for custody, right? They're very high. The LTVs are very low, and it's more rigid because managing a loan operation that's built around multi-sig is just it's got less flexibility. It's more rigid. It requires more, cooperation in real time with the key holders. It requires more security and governance around key management. Somebody leaves the company, you have to regenerate the keys, right? So there's just lots of different things you have to do to manage a multi-sig environment at scale. And that is why you see names like Fireblocks becoming so popular because of their MPC wallets, right? Multi-party computation, which is, you can think of it like a single sig, but it's sharded the individual key into however many parts you want, right? So the full key itself never actually exists anywhere for somebody to assemble and authorize any sort of transactions or movement of the Bitcoin itself. So it's an interesting scenario that continues to evolve, and I do think that as the banks get involved and as more regulated entities get involved, the custody best practices, the custody technology, and just how we use things like multi-sig and MPC and other things to secure the collateral and just be more transparent, provide more security to borrowers. I think those things are just going to continue to evolve in our favor, right? I think we are still early innings to where the companies like the one I work for and so many others are going to continue competing. We're going to keep building, adding more value, trying to get lower rates, trying to make things more efficient, more secure, more cost effective for borrowers. And that's just going to continue adding value for people like me, people like you. So I'm excited about what the future holds because I do think it will have some of the things like you're talking about and honestly a whole lot more.
It's interesting the higher maintenance of it, that the free market will basically thrive. So when we have less management with like not the multi-signature, they will be long term able to provide better rates and better and smaller fees. Basically, it's an interesting one. In general, I think. How early are we in this space? Because I feel like the banking sector is just slowly waking up to the idea that they actually should have the Bitcoin and should provide those services, like traditional banks, like your local banks, the community banks, the bigger banks in your country, wherever you are. I see now more like collaborations with Bitcoin exchanges and traditional banks that kind of try to provide something like that. At least in Austria, Germany, in that sphere, they're kind of getting started with that now. I would imagine in America, it's like a few years further advanced already than it is now here in Europe. What do you kind of see from the TradFi world, the banking world, coming into the space of saying, hey, we have liquidity and we would like for you to give us your Bitcoin?
Yeah. It's exploded and it continues to explode because I think another way to think about that question is coming from the other side of the the asset mix, right? What other assets are these institutions investing in, right? Real estate, right? Okay. Fixed income assets, bonds, sovereign debt. Well, okay. Commodities, okay. S&P stocks, NASDAQ stocks, right? That market's pretty heated. So I just think as an asset class, Bitcoin is really generating more interest everywhere, right? And I think so when you bring that into the TradFi space and capital markets and liquidity providers, the answer is absolutely yes, right? They are showing up and saying, hey, how can we get involved? how can we fund these types of loans, and what does it look like for us to put our money to work in a way that is risk averse, where the if there's a default or if there's a liquidation, right, we're on the other side of that. And so I think as these capital allocators and banking institutions, financial institutions learn more about how it works, and they learn that there's really no borrower risk or credit risk because, well, it's an over collateralized loan, right? They give us more money in Bitcoin than we give them in dollars. So if they don't pay it back, well, then we can liquidate the collateral to pay off the loan, right? And so there's really no credit or borrower risk, which is vastly different if you look at like an auto loan or an unsecured credit card loan or a mortgage, right? You've got borrower risk, right? If the people don't repay you, well, then you have to go repossess the house, or you have to chase them down to pay back the credit card, or you have to repossess the car, right? And there's just a lot of additional overhead and work that comes along with that. So that's one thing that I think the capital markets are better understanding. The other thing is the asset risk. Sure, Bitcoin's volatile, but the technology that exists in the lending space is advanced enough to where, a loan that gets upside down on LTV, loan to value, well, the collateral will get liquidated before the loan is in the red, right? So there's really no asset risk for these lenders either. And so as they start to understand this, they realize, wow, okay, the rates in this Bitcoin-backed lending space are, comfortably in the double-digit range, kind of hovering around double digits, right? 8, 9, 10, 11, 12%. And they're seeing, well, okay, there's really no borrower risk there. There's no credit risk with these borrowers, and there's really no asset risk because of the automated technology that will preserve the value of the collateral that's backing my loan. So the only real risk vector there is the counterparty, right? The actual lender, which would be, say, would be us, the company that's doing the lending, or perhaps the custodian that is overseeing the security and safety and custody of the Bitcoin collateral throughout the loan term. But again, I think as more people within the capital markets are understanding these things, they're going, okay, wow, that's a better business model. There's more upside there. There's fewer risks, and it's a growing sector. So, short answer, absolutely. Like the capital markets are growing significantly, and as that continues to happen, companies like mine are going to get access to cheaper capital, which means we're going to be able to give people like you lower rates, more competitive rates, which will drive down the cost of borrowing against Bitcoin and just make people want to do it even more.
And Bitcoin, as you said, like it's kind of the perfect collateral. It's if you compare it to like real estate, and it's kind of weird that real estate gets such better rates than Bitcoin, and there's no real reason for that. It's like real estate is a very risky asset compared to Bitcoin when you come to like how hard it is to kick someone out of a home, how hard it is to possess the home, like all the lawyers and legal things that have to be involved in that. And then you also have a risk of the home itself. And then with Bitcoin, you can just like liquidate it like right now in this very second, and you can do it instantly, remotely. You don't need lawyers. Like you have a contract, you have control over it, just liquidate it, sell it, done. It's kind of weird because like real estate still gets so much better rates than Bitcoin. And I think that's just like a sign that we are super early and that the banking industry still hasn't really gotten it, that Bitcoin is better. Like Bitcoin should get like 2 times better rates than any real estate. And currently it's like the other way around, and not only 2x, like probably like 10x. I don't know what the rates are currently.
Absolutely. Yeah, and I mean, real estate has just been one of those asset classes that has, it has a certain risk profile in the eyes of traditional lenders, banks, financial institutions. And to your point, you can't really run off with your house, right? So the default risk and the the risk of somebody just not paying on their mortgage is relatively low, especially for primary residencies. That's why for if you want to buy your primary house, it's the only house that you have a mortgage on. You can qualify for things like FHA loans here in America, where the loan is actually backed by the government, and so the banks require less down payment, right? So you can buy a primary residence with say 3% down, as opposed to if you bought an investment property, like you have to put down 25%, right? Because the thought process there is the risk of me, somebody who's buying my dream home for my family, right? The risk of me leaving and not paying my mortgage is a lot lower because, well, that's more important to me. I'm emotionally connected to and invested in that property. But if you look at like an investment loan to buy property, you need to put down 25% because I'm not as emotionally connected to that. It's a business transaction. I'm probably insulated through an LLC. So if I stop paying, well, then it's gonna have to go through the LLC. But so I think back to your point though, yes, there's a lot more comfort and there's a lot more historic, precedent for growth and appreciation, which we know is due to inflation for real estate, and therefore you do get better rates, you do get more competitive rates, and banks do have a sort of lower risk profile associated with real estate as opposed to Bitcoin, which is still, moderate. They view it as being more of a moderate to high risk asset class. It's more volatile, and that's why the rates are still higher. But I do think that as more players get involved who do have access to cheaper debt vehicles to be able to raise capital more cheaply, right? Perhaps we even get to the point where eventually lenders who have access to central bank borrowing, right, and have access to the Fed window and things of that nature. I'm sure that's not too far off as well, at which point, the cost of capital for lenders is going to be more like, 3.5, 4, 5% as opposed to, 7, 8, 9, 10%.
Yeah, I'm really questioning like long term, like how long it will take the banking sector really gets that Bitcoin is the most pristine collateral, that Bitcoin is the one thing that they actually want to own. And I'm really looking forward to almost like a war between banks who can offer the best deal for Bitcoiners, to give them their Bitcoin, to give them cash for the Bitcoin. I think we haven't even seen the beginning of that. Like we were just like, I don't know if the target is on like a hill. I don't think if we even like started going up that hill yet. It's there's only a few really good banks that got it a little bit. There's in Germany one that really looks at Bitcoin, but it's mostly driven by like 1-2 people there. And then there's in America a few ones that got it, but even those Bitcoin is usually a smaller project within the bank. And so this is the most interesting for me. When will they kind of get, we want to have all those Bitcoiners? Because now there's exchanges like River, like Relay, like a lot of other exchanges that have the Bitcoin from the people. They provide the financial services. And at some point, they will look at all those big exchanges that are slowly getting bigger and bigger. And the banks will be like, they're kind of taking our space. Like they're kind of taking our share. Like what the heck is going on?
Right. Yeah, I mean the future of lending and custody and trading and how Bitcoin interacts with and overlaps within the traditional banking space is very, very fascinating to me, because you're right. I do think that once the regulatory guidelines and frameworks are more clear, once they figure out, okay, are we as a bank able to offer any asset protection, right? Because today banks can offer FDIC insurance on your deposits or my deposits at a U.S. financial institution, right? So if they go bankrupt or something happens, right, my cash is protected, at least in theory, right? And so I think there's still the question of how will that evolve, and apply to, say, Bitcoin, which is viewed as a form of money, right? So if you, as a regulated financial institution, are able to manage my money for me in the form of Bitcoin, can you insure that for me as well through a similar mechanism, a similar protection service like FDIC insurance for my cash? So that's one question I'm eager to see how that evolves over time. But I think the other thing that you pointed out is that, yes, as these risk and underwriting and profitability models are evolving, they're starting to look more at the future appreciation value of Bitcoin. They're looking at the growth and the CAGR as really their economic upside, as opposed to strictly at the risk, right? Because most risk models are based on, well, what happens if the borrower does this, or if the market does this, or if the property does this, or whatever, as opposed to, well, okay, if Bitcoin does a 20% growth CAGR for the next 5 years, what does that look like for us if we're getting, say, 25% of that in exchange for, I don't know, offering some kind of yield on the Bitcoin that's being held with us, right? So there's just, I think, as these rules, as these best practices, as these risk and underwriting and profitability models within the banking space evolve, more innovators, more mavericks, more people that are kind of on that bleeding edge are going to show up and say, hey, we've now got a service that gives you 8% back for putting your Bitcoin here because of X, Y, and Z. And they'll have a risk model that tells them that that's what makes sense for their business. Something kind of like what Strategy is already doing with their preferreds, right? With their Stretch, their Strike, their Stride. They're offering much better returns, much better upside, much higher benefits to basically the same types of products that we've been able to buy through traditional equities, traditional S&P based equities and publicly traded companies for decades, right? So again, you've got kind of an example of that where, because Bitcoin is powering the nucleus of those offerings and of that company, you're seeing higher upsides, you're seeing higher returns than the more traditional products that we've kind of seen and had our arms around for, the better part of 100 years. And so I think as the banks start to do the same thing, they're going to develop new risk and underwriting models. They're going to develop new profitability models that are based on the future value of the Bitcoin assets. And therefore, some of those benefits will start showing up in the everyday banking products and services that they offer.
Yeah, I think so too. I think this is like a natural step for Bitcoin and the banking world to kind of intersect. One thing you mentioned in the book, which I found interesting, is the measured in Bitcoin. So like wealth measuring in Bitcoin, income measuring in Bitcoin, and it's harder. It's harder than it sounds. But once you really get to the point of like, I want to measure the income that I have, my wealth that I have in Bitcoin, you realize that it's really hard to keep up. It's like almost like impossible to keep up with the income, and also your wealth is like, oh, like you only apply a little bit more. And it's actually very sobering, because we live in this like fiat world where like everything goes up all the time. Like we're making net worth jumps of tens of thousands, hundreds of thousands of euros and dollars every year, and then the salary goes up 5-10%. But then you realize, oh, measured in Bitcoin, oh yeah, actually income is going down and net worth is going up only a little bit.
That's right. That's right. Well, and I think the other thing I like to get people to think about too is, like, I've been converting all of my income to Bitcoin for almost a year now, and I haven't sold any of it, right? And so if all of my income from 2025 has been converted into Bitcoin, and I've borrowed dollars against that to live my life, right? Sure, even if I have the same value of Bitcoin today that I've gotten paid in dollars, what does it look like in 5 years if I still have all that Bitcoin, never sold it, and then Bitcoin hits 500K, right? What was my salary in 2025 if all the Bitcoin that I converted my income to is still sitting there, right? And the answer is, well, it's a significant multiple of what you were actually paid. And that's the benefit, right? That's the whole thesis is if you own Bitcoin, well, and it keeps appreciating in value, well, then the Bitcoin that you earned in prior years is going to go up in value as well, right? So if I clear $100,000 in paychecks in 2025 and all of it was converted into Bitcoin throughout the year, at the end of 2025, my Bitcoin might only be worth $100,000, at which point I didn't get a raise. I didn't actually make anything if I'm looking at it right then and there. But what happens when Bitcoin goes to, say, 250K or 500K, right? All of a sudden, my $100,000 that I earned in 2025 are now worth, say, $500,000 in Bitcoin value, right? And that's the point, right? Think ahead and own Bitcoin, right? Own the Bitcoin, buy the Bitcoin, get the Bitcoin today, and try to figure out how to just rent the dollars that you need to get through the daily, monthly, yearly expenses.
100%. The Bitcoin is the valuable thing. And if you can figure out how to keep as much Bitcoin as possible, you should probably do it somehow.
That's right.
We have one question that I ask each and every one of my returning guests. And the question is, what have you learned outside of Bitcoin since your last appearance on the podcast?
What have I learned outside of Bitcoin since the last podcast? Oof. I don't know, man. Most of what I do is all right in Bitcoin. So, I've definitely learned a lot more about the macro environment, right? Our relationship with China and other large trading partners, economic, military, counterparts across the world, and just sort of understanding what they're doing and how their strategies are based on the same things that do power Bitcoin. I know you said outside of Bitcoin, but just understanding like the run up in gold as an example, and what's leading to that, and why people across the world are ditching dollars, and why central banks are getting rid of their treasuries and accumulating gold. It does sort of come back to the same thesis, the same value proposition for Bitcoin, but it's been really interesting just to learn more about that stuff and kind of see some of it happen in real time.
Yeah, I love that. Coming back to basics, basically.
Yeah.
We have a question, as you know, where the previous guest is asking a question for the next guest. The end routine, asking a question for the next guest without knowing who the next guest actually is. And it's an interesting one. What is the sport you think you would beat Robin in? So like what sport is the sport that you think you're better in than me?
I'd have to go with bowling.
You if you bowl anything, you probably are way better than me, because I think I did bowling maybe 2 times or 3 times in my life. So if you did it more than that, you're probably a lot better than me.
I don't know about a lot, but you can't see it, but I do have a bowling trophy over there. So I do.
Gosh, you're like way better than me then. You did bowling like a trophy that you won in some like small tournament, or like did you actually do it professionally?
No, it was an amateur, more of a fun league, but it was, it was a lot of serious bowlers. It was a team league. It was 32 weeks, and there's a big championship tournament at the end. And me and my team, we did that league for 8 years, and we finally won it 2 years ago.
Gosh, yeah, you will be so much better than me. I still struggle with just bringing the ball there. But yeah, thank you so much, Sean, for being on and bringing all the insights for the borrowing against the Bitcoin and buying Bitcoin and getting the renting the dollars. That's how it's called, like owning Bitcoin, renting the dollars, right?
That's right. Own Bitcoin, rent dollars. Yeah, the ebooks, you can download it right on the homepage of bitcoinmath.org. And yeah, appreciate you having me on. It's a great, fun, evolving topic, and I think as more people learn more about it and kind of better understand the tools, the best practices, the risk strategies, I think this will continue to be a very popular conversation topic within the Bitcoin and finance space moving forward.
I think so too, and I think it will actually become even more popular within the next 5 years. I think we are just witnessing the start of that whole thing. But yeah, thank you so much for being on the podcast and being such a gracious host, gracious guest. Thank you so much for being here. And also thank you so much for everyone that is watching and listening, for joining us today. As always, I'll be back tomorrow with another episode. Bye-bye. This content is for educational and entertainment purposes only and does not constitute financial advice.